We're seeing the S&P up fractionally. However, the Dow is still down fractionally. The big story today, though, rates. The 10-year back above 4% right now at 4.038, just a tick higher than it was earlier today. And I think that's really where we really have to start. Just a short time ago, we heard Chicago Fed President Austin Goolsbee talking right here on CNBC. Our Steve Leisman doing a great interview. He basically said he believes that a soft landing can happen even with 2 more hikes, Jim. What did you think about what he had to say, and do you think that still is possible?
I do think it's possible. It's actually my base case, Frank. Now, I got to admit, I didn't like the 0.4% month-over-month gain in average hourly earnings, but let's see what CPI looks like next week. 1 to 2 more rate hikes, I think the market can withstand it. I think the economy can withstand it. We've already seen that, right? I mean, just think that it was November 2nd that the Fed raised rates to 400 basis points, 4.0%, and yet here we are 8 months down the line, 8.5 months down the line, and this economy is still producing multi-hundreds of thousands of jobs a month. So this is an economy that is stronger than people expect. And I think it can withstand, as I said, 1 to 2 more. But here's where I get worried, is CPI is coming up next week. If that disappoints and it's hotter than expectations and we start talking about 50 basis point hikes, which, by the way, some people were talking about yesterday after that hot ADP report, then I think you got to start to worry about the regional banks again. I think you got to worry that this economy can't withstand that much. But 1 to 2 more rate hikes, yes. For me, it really depends on that CPI next week.
Yeah, not only CPI, but PPI. Kevin, what did you think about what you heard from Austin Goolsbee and the fact that now we're seeing the 10-year back above 4%?
Yeah, well, I think it was a big shocker when we saw that headline number yesterday from ADP. But they tend to converge at times, and this week was a good example of it. But if you look at it year to date, ADP is 263,000 jobs per month, and BLS is 278,000 per month. So it puts things in a little bit better perspective, which I think may take that 50 basis point threat off the table. 25 basis points in July, absolutely still a go. Whether they do another 25 the following month or not, I think it's still a high possibility. But yesterday, I think it was a certainty.
Steve, what are you thinking? I mean, Jim pointed out something really important here. Hourly wages rose more than expected. A lot of people see that as a key metric, as an inflation proxy, if you will. Do you, in your mind, 2 more hikes definitely happen, as Austin Goolsbee laid out? And does that also lead to a possible soft landing? Do we avoid recession? Or does that cause something else to break?
I think it'll be a mixed recession. I think clearly the people that live paycheck to paycheck and did before the pandemic, during the pandemic, and now they're disadvantaged because they're still seeing prices go up. Right. Granted, the pace of inflation has slowed, and you could see a number that's really sub-4, nicely sub-4 this time, but they're still hurting, and we see it in terms of some of the retailers, what they're reporting. On the other hand, you know, corporations still suffer from PTSD, which is shortage of labor, so they're not, aside from the big tech companies that laid off a lot, they're not really laying off. But 2 rate hikes, in my view, are a certainty, because not only did you get wages increased, right, you've got labor participation rates staying flat. You have work week moving up. You want to see work week moving down as a precursor to lower numbers, and you're still above 200,000 jobs. Right. So that's not where the Fed wants you to see. The good news is that women participation rate is the highest it's ever been, besting last month's high. Where that's good for healthcare, because a lot of women go into healthcare or services, so that may help give some relief to the healthcare sector, which has been killing them.
You know, to your point, healthcare, one of the areas seeing the biggest jump when it comes to hiring. Josh Brown, I want to come over to you, just bouncing off what Steve had to say. He talked about working class people being the most deeply impacted. You're one of the people that's really been flagging the kind of the bifurcation when it comes to the economy and consumer spending. So if working class people are hurt possibly by 2 more hikes, doesn't that hurt the overall economy and the markets?
So it's tricky, because for every story I could tell you about working class people being hurt by higher borrowing rates, especially when it comes to things like auto loans or credit cards, I can then tell you the other side of the coin is wealthy people making more money than ever in their portfolios. We've just had the best first half of the S&P 500 since 2019, and people with big bond portfolios, whether we're talking about corporates, municipals, treasuries, money markets, are now getting a ton of income on their excess savings, and that is in part fueling some of the animal spirits that we continue to see in real estate, for example, vacations, et cetera. So it's really tough. to point to one specific economic variable and say it's good, it's bad, it's bullish, it's bearish.